Welcome back to part two of my conversation with Mr. Stephen Van Metre. Where we left off in part one, QE. QE is likely to be on the horizon, not just the Bank of England, although Bank of England is probably not going to say that what they're doing in their gilt operation is quantitative easing, and probably it isn't. But that's beside the point. The world is heading in a direction that is likely to lead more than just the Bank of England, but central banks around the world back to where they probably want to be anyway, which is in QE mode. And the reason is, well, there's a bunch of reasons. We got deflationary money, as I talked about in a previous episode, warning signs, all sorts of warning signs, not just around the world, not just the US dollar's exchange value, but in the US dollar system itself, SOFR, T-bills, and tips. As Steve just asked at the end of the first part of our conversation, what is the market saying about all that? What is the market saying about inflation or consumer prices? And you probably won't be surprised to learn it is saying that, yes, the world economy is likely heading back in the direction of more QE because consumer price expectations aren't just falling, they're falling precipitously. The tips market has been, of course, tips inflation break evens in the tips market do tend to track oil prices as you would expect because oil is the largest contributor to the CPI, and the CPI is what the government uses to pay back in the inflation protection. So there's usually a good correlation between tips and oil prices. But going back to March and really into April, May, and June, July, where we saw that second major deflationary outbreak, tips inflation break evens have been falling more than oil prices, which suggests that the market is thinking, yes, we see oil prices coming down, but we're also starting to think consumer prices are coming down in addition to lower oil prices. And that gap has only widened over the last couple of weeks to the point that this week, the same week when we had these German numbers, these European double-digit inflation numbers, consumer price numbers, this red hot supposedly PCE deflator, whatever, tips inflation break evens, the 5-year break even, the 10-year break even, both declined to their lowest level since January 2021. So essentially, inflation break evens in the tips market have entirely round tripped already the supply shock, and they're still going lower. And I think that was interesting about yesterday. For people who don't know, today is what, Saturday, October 1st. So yesterday, September 30th, we got the PCE numbers, we got the European numbers. Germany was the day before. And inflation break evens in the US actually fell a little bit lower on Friday, even after all of those numbers came out. So still lower break even rates, which says the market is, as you just said, Steve, kind of throwing in the towel on the supply shock, saying, well, it isn't maybe definitely here right now, but we can start to see it coming closer and closer and closer. And as you just mentioned, Nike and some of these other corporate anecdotes that are coming out, companies are telling you inflation is done. We have to not only just mark down inventory, we've got to liquidate a whole bunch of it. What do you think that does to prices? And I think Nike's warning, Urban Outfitters, and the several other retailers have said, it's not just this next couple of weeks or next quarter. This inventory problem is going to linger into next year.
Well, yeah, and you tack onto that is what is a big driver, and we've talked about it on this show, of sentiment and people's desire to go out and spend, and that's the stock market. So we're seeing it all of a sudden just, nothing seems to be slowing its downward move. Now it's not moving rapidly down, but it's continuing to move lower and lower. That's going to weigh on consumers' minds. And there could be a possibility here where we see discounts and consumers say, sorry, I still can't afford it. Look at my 401k, look at my retirement accounts. I retired early because I thought markets only went up. Man, they're down a bunch. There's no way I can pay. And I think that retailers, they sound still optimistic to me, Jeff, when I hear them talking. I don't think they realize that if things continue to go down the path that they're headed, this inventory could get to the point where they're scrapping it because it's outdated, and that's really not going to be inflationary.
That's what Nike said, right? Nike said that we've got stuff from the previous season that we don't want, we can't sell because it's already outdated. But I think the retailers are doing what retailers do for corporate roadshows and earnings reports. They put on the happy face, and as soon as the camera turns off, they're like, "Oh crap! What the hell are we going to do?" Right? And I think that's what the market is sensing. That's why you saw bond yields fall when Bank of England announced their QE program, their not QE program for the week. Yields actually fell in the United States and elsewhere because The market is starting to sense that all these things are coming together. Like I said, the phony war. And I want to throw one more number out there that we got this week from yesterday, the PCE, the personal spending and income numbers, the personal savings rate. Now, the BEA, they did annual benchmark changes to all their data, which meant they revised personal spending and income both higher, but mostly for the depth of 2020. And then it was a little bit better in 2021. Over the last year, it has been primarily the same. However, the net result was that the personal savings rate over the last 3 months has fallen below 4%. And that's a level that usually you associate with recession for good reason, because as you were just saying, not only are consumers looking at their 401ks or their stock holdings and saying, these are going down, and they've been going down for almost a year now. We also have incomes that aren't keeping up with prices in gasoline and food. And on top of all that, the low savings rate tells us the stimulus is gone. The magic from Uncle Sam has dissipated. And now we have a problem where consumers are going to have to cut back, even if they don't want to, because they're running out of income. And I think that, to me, is the specific correlation with what we're seeing from retailers. Retailers have realized that consumers have hit the wall, and they're starting to make all these. Not only do we have inventory problems, we also have a demand problem. And when you have an inventory problem at the same time as a demand problem, that's when you get prices falling rapidly. Right, Steve?
Yeah, absolutely. And of course, there's one thing we'll tack onto that is we have a debt problem, because unlike prior stimuluses where you actually saw people spend down or pay down their debt, which we did see initially, but of course, like anything, when the checks keep rolling in, you think they're never going to stop. Well, all of a sudden we saw consumer debt, credit card debt start to go way up. And of course, thanks to central bankers raising rates, now credit card interest rates are going to go higher, minimum payments are going to go higher. And of course, that is all that's going to do is weigh on consumers' minds, lead to less spending, because at some point they're going to say, hey, you know what? If rates keep going up, this debt's out of control. I've got to pay it down. I don't need those year-old shoes. I didn't like them anyways because they're out of style. And that's going to be a big problem for a lot of these retailers who are stuck with this inventory.
This is something I've thought about too. I'm glad you brought that up, Steve. Is I wonder how much some of these other aid programs like PPP and others, now of course we're seeing it with canceled student loan debt. I wonder how much the government influenced that type of behavior. How many people thought, well, this is COVID, this is a pandemic, this is a once in a lifetime emergency. I'm going to load up on debt because as I'm looking everybody else around me, everybody's getting their loans canceled and forgiven. I'm going to take on a bunch of debt because the government's going to bail me out. That's what everybody was talking about. All the politicians were talking about over the last couple of years is how do we bail everybody out? And now we're seeing it in student loan debt. So you have to wonder because like you said, that was absolutely the opposite way is usually what happens. You get into these sticky economic situations and people act prudently. They cut back on debt because that's the prudent thing to do when you're uncertain about the economic future. But that was not the case after 2020 and 2021, where the government said, do everything we've got. It's all on us. And I wonder how much the government influenced that behavior, the destructive behavior.
Well, I think they did a lot. And I think people actually believe. I remember talking to people during it while they were getting their checks. They said, I'm not worried. And I said, why not? They said, look, the next time things go wrong, this is all coming back and even bigger. And I said, I have a hunch that this is like a one-time deal. However it works, it's just not going to work out well. And sure enough, I mean, we could see a change just at the midterms, perhaps in sentiment from the government if parties change. But I think the other factor you have here is, what would you rather have? Checks that lead to unattainable inflation, so it doesn't matter anyways, or do you want to go back to the way things were? And I wonder if people are going to be ready to go back, or if they want even higher inflation, because you start to ask, Jeff, are you worse off now, right? And this is a question consumers ask and determine their spending. Am I worse off now or before? And I think people they thought they were bad off before the pandemic. I think they now look back and say, wow, things were actually pretty good. The government actually made it worse, even though I thought they were making it better.
Yeah, I think that's really the point here. We'll wrap it up with that, is that, the government, initially everybody thought we need to do a lot more. And then consumer prices exploded. And now there's this Now the government, I think, is going to be very gun shy about the next one. Certainly the Fed's going to be gun shy because the Fed's going to get blamed for all of this, every last bit, the up and the down. Jay Powell's neck is firmly in the noose. Whether he knows it or not, he's been fitted for the gallows anyway. And then you have politicians who, of course, are running around knowing they're being blamed for consumer prices when they did have a huge part in it. That was a big part of the supply shock. So as I said, more QEs down the road might be a little bit further down the road than maybe normally when central bankers were only itching to get back into the QE. Government's only too happy to go further down the road toward MMT. I wonder if there's a little bit of a little gun shy this time though.
Well, I guess we'll find out if consumers are excited about it. I have a hunch though. I think people are worse off now, and I think people are looking back saying, maybe I wish this all didn't happen. And the pandemic did happen. The response didn't have to be that way. But when people are looking out at the economy right now, they don't see inflation coming down. They don't feel that their business prospects are getting better. Their employment prospects, despite, of course, the government saying there's all these jobs, they're not seeing it. They're not seeing it get better. So the question is, to me, where all this goes is all up to the consumer. And I know you agree with me, Jeff, because if they stop spending, there's no way the inflation continues, and there's no way we go back to what we just did.
Yeah, let's leave it there, Steve. And I think, one last final point is that, even if we do get into a disinflation or even deflationary environment, we don't see prices go back to where they were. So we suffered the supply shock, prices adjusted. Now the overall economy has to make do with what already happened. You can't go back in time. You can't go back in economy. So thanks for joining us. For everybody out there who doesn't know already, Steve and I, we work for Atlas Financial. So if you want to check us out for portfolio management services, go to portfolioshield.net. We also have a research product that is now launched, a joint one, together with Tracy Schuchart. It's at marketsinsiderpro.com. You can check it out there for some research products. Otherwise, just go Eurodollar Diversity, see what's up with the Eurodollar University. Where's the meal? All these other kinds of questions that are running around. SOFR, tips, inflation, all the good money stuff. So again, thanks for joining us again, Steve, and we'll see you again next time.
Thanks, Jeff. It was great to see you and great to be on the show. And Les, we'll leave the audience with the question, where's the meal?
All right, see you later.